cash flows are going to go down for future properties that you purchase. And the reason that is happening is because home prices have gone up. Interest rates have gone up. We knew that was going to happen. And although rent rates have also gone up at a rate that is faster and higher than the norm, they have not kept up. And this isn't a new phenomenon. This happens most market cycles anyway. So we knew this was going to happen. This is what we have talked about. But if you look today on the property that you're purchasing for a turnkey rental property and look at the cash flows for that property versus where they were 2 years ago, it's a different story. You flat out are earning less cash flow today from this investment than you did 2 years ago. And as home prices continue to go up in the future, guess what, Pablo?
What you see?
This phenomenon is going to continue. It's likely to continue. This is one of the reasons why when you decide that you want to buy a turnkey rental property, you want to put this into your financial portfolio, that's usually the best time to invest. It's because over time, home prices tend to go up. Rents don't keep pace with home prices. And there's some variability about what interest rates are going to do, but we still have very low interest rates compared to the historical interest rates. And so when that happens, you generally are setting yourself up for a future purchase that you might buy 1 year from now. It's probably going to have lower cash flows than it does today.
Yeah, I mean, that makes a lot of sense. So, I mean, we've been seeing property after property, right? Like we've been gone from a period where you could put 20% down and maybe still make it like $100 a month, right? To like now where it's more like 30% to maybe make 50 or 80, 25% to be right at break even. So the monthly cash flow continues to get squeezed. And what are we to take from that?
Just because cash flows are coming down, does that mean that this is a bad investment now? Right?
I mean, not the way that I've been taught this, right? Like you have taught me to see the cash flow as the entry to the dance, right? And like you have positioned the idea of different markets having different qualities. So if I am investing in Jacksonville, I am investing for growth. Whereas if I'm investing in like Montgomery, Alabama, I'm investing for cash flow and giving up the growth.
Yeah, there's a lot that goes into the right decision, for the right market. So there's cash flow, there's growth, right? That would be home price appreciation. But there's 5 profit centers as to why we're investing here. And I think what is happening now, and we have been talking about the 5 profit centers for a long time. And what I predicted a couple of years ago when we started to do the show is that if turnkey rental property companies were going to be successful, they were going to have to learn the 5 profit centers.
That's right.
They were going to have to become good at it. They were going to have to sell their properties based on it. And then guess what? If you look at evaluations from turnkey rental property providers from years and years and years ago, there was no mention of tax savings. There was no mention of principal pay down. There was no mention of home price appreciation. But now if you look at those property valuations, now people talk about that. This is becoming more of an understanding, more of a reason to invest. But the reality is that this was always the reason. The 5 profit centers were always the reason that this asset class did better than the stock market. And it seems like a new phenomenon here, but to me, it's like, listen, if you didn't understand that this was the reason why you were investing in rental properties back in the day, you were missing the big picture. So like now, because of the market dynamics, because cash flows are going down, we're all forced to understand the big picture. This is why the 5 profit centers are the reason why this asset class is better than most alternatives out there.
So 5 profit centers, cash flow, which we like to call the entry to the dance, right? The closer it is, the more positive it is, the more scalable the investment becomes. Once it becomes cash flow positive on a monthly level, it means that you can add more and more without dipping into your own income as you are building this thing out long term. Then there's the debt pay down, right? The idea that your resident is paying down a mortgage that you took out. That's what Tim Hicks famously coined as like, worst comes to worst, somebody's paying off a loan for me, right?
Beautiful.
And building equity. Then there's tax savings. I just got to tap into that, right? I just finished my 2021 taxes right on time. I owe a little bit, because I also cashed out a 30,000 stock gain. That's
Not much I can do there.
not much you can do there, but it really totally lowered my tax base, right?
That's
Like, so
awesome.
yeah, it was really, really cool. So yeah, so those tax savings that you're saving there is the inflation hedging, which is becoming more and more important right now in incredibly inflationary times. And then there is home price appreciation. The way that you have taught me, I think you have taught all of us here, the way that I conceptualize it is, if I'm investing, the more short-term the window, the more I care about cash flow, the longer term the window, the more I care about home price appreciation, because that's the thing that really pays over time. Is that kind of it?
Well, you're throwing me for a little bit of a loop there. The short term, and the more I care about cash flow, the long term, more I care about home price appreciation. Tell me a little bit more about your thoughts there, because I want to make sure.
Yeah, if I plan on living off of the cash flow that this thing is spitting out,
Yeah.
then I really care about cash flow, right? Because I need to use it to pay for my cell phone bill or my prescriptions or whatever is happening. If I'm not really doing this in order to pay for things that I pay on a day-to-day basis, then what I really want is my money making money for me. And therefore, the longer the window until I need my money to make money, until I go from money making money for me to me living off of my investments, the more I care about home price appreciation.
I would frame this a little bit differently. So the short run, long run, if people are thinking about short run or long run and they're coming to rental property investing, I don't think this is built for the short run.
Okay.
Right. So this is not the right asset class for you. If you're trying to buy something today and you're trying to sell it in a year and you want to make a great risk adjusted return on investment, because real estate is an expensive thing to sell. And the reason that I say that is, even if the market does go up in value, you still knock off roughly 10% of your sales price in selling, holding, and closing costs. So even if you have strong cash flows, and even if the house appreciates, you're still going to give so much back just because of what it costs to sell, to hold the property while it's selling, and then there's closing costs, that it's not built for the short run no matter what.
Okay.
Right. And I think that's a really important point, right? Like, many people don't think about that. And what has happened over the past couple of years encourages people to come in for the short run too, because they think that you can get these incredible gains over the short run, and that's normal, and it's not. So let me kind of separate that. Like, short run investing, I don't think rental properties is the best thing for you.
Okay.
There's a lot of other things you can do.
And to be fair, we are also talking about financing a rental property, right? Like, there's a big difference between buying a rental property cash and living off that cash flow versus putting down 30%, taking a mortgage out there, and then letting leverage do its thing, right?
That's the differentiator. So for somebody who is in rental property investing, you got to be committed to the long haul. If you want to earn the best risk-adjusted return on investment, you got to be committed to the long haul. However, if cash flow is really important to you because of your quality of life, meaning maybe you are nearing retirement and you need to replace active income, and you want to do that through rental property investing, then it's more of a cash purchase, which is not using financing, or is this using financing? Cash purchase will get you immediate cash flow, right? You'll have better cash flow coming in than if you would if you were putting that in a bond or something. But if you use financing, you're going to get less cash flow. It's less than if you would put into a bond. It's still positive, but it's less cash flow, but your upside is so much higher. The need for cash flow, to me, really determines cash versus financing on the type of purchase.
And another differentiator that I want to say that Noah brought up, this is for investing in a rental property today.
Yes.
Versus tomorrow, right? If you own rental properties, cash flows are going up.
Yeah, thank you. You know, I always want to make sure I specify that. And that's such an important point. When you already own the assets in your portfolio, you're in the driver's seat. You have a hard asset, especially the way that, you know, macroeconomics are working right now, which is where there's significant rental demand expected for a long time. You should continue to see home rents go up. And so, yes, the cash flows you already have in your portfolio are in a great spot. I don't see those going down. In fact, I see those going up like you're talking about. I'm specifically talking about that investor who's like, should I buy right now? Or should I buy that same property a year from now? Buying that same property a year from now will actually get you most likely lower cash flows than you have right now.
Got it.